Okay, let's unpack this. We are diving headfirst today into a topic that sits right at the electrifying intersection of finance and cutting-edge technology.
Hmm.
The tokenization of private equity. Is this a groundbreaking new frontier that's about to revolutionize how you, the investor, interact with markets?
Or is it facing some pretty significant hurdles? Maybe even more hype than, true substance.
Exactly. That's the core question we're tackling. We're going to explore all sides, sifting through a stack of sources to get to the heart of it.
And it's an incredibly timely discussion, really vital right now. This whole concept of tokenizing real-world assets, RWAs, it's much more than just a buzzword, isn't it?
Definitely not just buzz.
No, it's a rapidly growing trend. It keeps grabbing headlines, sparking intense debate across both traditional and digital finance.
And the scale is pretty staggering when you look at it.
It really is. To really grasp the scale we're talking about, think about this. The total market cap for RWAs is actually closing in on $25 billion.
Wow, $25 billion.
Yeah. And a big chunk of that, about $14.5 billion, to be precise, is already sitting in private credit.
Right. So this isn't just theory anymore.
Not at all. This is a burgeoning space.
Yeah.
There's tangible value flowing through it already.
Yeah.
It demands our attention and a clear understanding.
Absolutely. And that's precisely our mission for this deep dive, to explore the true demand for tokenized private equity, to unearth the inherent risks that, well, inevitably come along with something this new,
Always risks.
and to really scrutinize its actual accessibility for you, the everyday investor. We're going to be sifting through a stack of expert opinions, looking at different company approaches.
Pulling insights from like analytical platforms, RWA.xyz, for instance, but also candid interviews with CEOs who are right there on the front line.
It's going to be a journey into what could genuinely be the next big wave in finance.
Or potentially a bit of a cautionary tale about moving too fast, maybe.
Could be. We'll see. Now, before we jump right in, just a quick note. If you find these deep dives helpful, if you want us to keep bringing you this kind of in-depth analysis,
Yeah, things like subscribing, commenting, just engaging with the content. It really does help us out a lot.
it really does. It boosts visibility in the algorithms, lets us keep creating quality deep dives just like this one, tailored for listeners like you.
So a big thank you in advance for that support. It means a lot.
Okay, let's get started.
Let's do it.
So let's kick things off just laying down the fundamental idea. RWA tokenization, what is it in simple terms?
Right, the basics.
At its core, it's about taking assets, tangible or even intangible ones, from the traditional financial world.
Like real estate, art, commodities, gold maybe.
Exactly. Or in our specific case today, company equity, and representing them as digital tokens on a blockchain.
Okay.
Now, for many of us, the immediate appeal is pretty clear, right? It
Yeah.
promises increased liquidity.
For stuff that's normally really hard to sell quickly.
Precisely. Assets that are otherwise incredibly illiquid. Imagine trying to sell like a small piece of a commercial building fast.
Or a fraction of a famous painting.
Yeah,
Yeah, not easy.
right. Tokenization promises you could potentially sell that fractional stake much more easily. It also opens the door to fractional ownership itself.
Meaning you don't need millions to buy the whole building or the whole painting.
Exactly. Or even a full share of some super high-value private company. And theoretically, this offers wider access.
Access to investments that were, let's be honest, previously way out of reach from those people. Reserved for institutions or the ultra-wealthy.
The velvet rope investments.
That's a good way to put it.
Yeah.
And when we zero in on tokenized private equity specifically, we're talking about a realm that, like you said, was traditionally exclusive.
Very exclusive.
Venture capitalists, big institutional investors, pension funds, endowments, and that specific group, accredited investors.
Right. Those folks who meet certain income or net worth thresholds.
Exactly. Usually something like $200,000 in annual income or $1 million in net worth, not counting their house. The idea being they can handle the higher risks involved.
Because these private investments are riskier, less liquid.
Precisely. So theoretically, tokenization here means allowing a much broader range of investors, including you, the listener, to own a verifiable digital piece of a private company.
A company not listed on the stock market.
Right, through these digital tokens. The core promise is democratizing access to that high growth potential you often see in early stage or private companies.
Getting in before the IPO, basically.
That's the dream, isn't it? offering a peek behind that velvet rope.
Okay, so that's the theory. But here's where it gets particularly interesting and where a lot of the recent chatter really ignited.
Ah, the Robinhood OpenAI saga.
Exactly. We have to talk about this. This specific incident just grabbed massive headlines, sparked huge debate.
So what happened there?
Well, Robinhood, the big U.S. trading platform, offered European investors something they called tokenized shares linked to OpenAI.
OpenAI. Wow. The absolute hottest name in tech right now, probably.
Right. So you can imagine the splash this made. A major retail platform seemingly giving everyday folks a shot at OpenAI.
Whose valuation was just going through the roof.
Totally. It dominated headlines. The media attention was huge, fueled by all the AI excitement. It felt like a potential game changer.
Like maybe this was it, the future where access to these pre-IPO unicorns was finally opening up.
That was the vibe, but then the details started coming out.
And this is where that critical distinction and, frankly, a lot of the confusion emerged.
Da-da.
Despite the initial hype, and even Robinhood CEO Vlad Tenev talking about stock tokens at one point.
Yeah, I remember that.
These tokens were emphatically not actual equity in OpenAI.
Mm.
No voting rights, no real ownership stake.
Okay, so what were they then?
They were basically a derivative product.
Yeah.
Designed purely to track OpenAI's valuation.
So like a bet on the price, not owning a piece of the company itself.
Exactly. Think of it less like owning shares, more like a contract for difference or something similar, just tracking the value, which is a very different thing for an investor.
Crucially different, and OpenAI itself wasn't thrilled.
Not at all. They quickly distanced themselves, explicitly stating these tokens didn't represent real equity in their company.
Ouch.
Yeah. So you had this huge gap between the perception, direct ownership in OpenAI, and the reality, which was an indirect bet on its value. Different risks, different rights, less transparency overall.
It really highlighted that difference between seeming access and actual ownership, didn't it?
Absolutely.
And despite that misrepresentation maybe, or perhaps because of the hype and then the clarification, this whole thing just provoked a massive conversation.
It really did, even though it wasn't real equity.
Why do you think that was?
Well, I think it tapped into two really powerful undercurrents. First, just the sheer growth of the RWA market we talked about. It's already significant. It's growing fast.
So this incident, flawed as it was, showed the public appetite.
I think so, yeah. It showed people are interested in this new frontier. And second, it tapped into that, well, almost insatiable desire among regular investors.
To get in early.
Exactly. To get early stage access to these super buzzy, high growth, private companies. Everyone wants a piece of the next Google or Amazon before it goes public.
When most of the big gains happen, arguably.
Right. So the Robinhood OpenAI thing, even with its missteps, inadvertently shoved the potential of democratized private equity, even if it was misunderstood, right into the public spotlight.
Forcing a conversation about what real access actually looks like.
Precisely. What does it mean? What should it look like?
Okay, so that sets the stage perfectly. Now let's dive into the core argument, the real contention. Is the demand for tokenized private equity really there?
Or is it more of a, build it and they will come hope?
Exactly. We hear the buzz, the promises, but what are the folks on the ground, the CEOs actually building in this space? What are they seeing? Let's start with the skeptical voices.
Because they raise some really valid practical points that often get lost in the hype.
Definitely. And one of the clearest voices here is Gabe Ott. He's the CEO of Dinari, a company that actually started out focusing on this very area.
Right. They were early explorers in tokenized private equity.
And he has some pretty interesting firsthand observations about demand.
Ottie's findings really cut to the chase. He framed it as a fundamental supply and demand issue, a classic economics problem.
Okay.
He put it pretty directly. He said, the issue we found was more about supply and demand.
So not just about investors wanting it.
No. What Dinari saw, this is a couple of years back when they were really digging into it, was a significant supply-side constraint.
Meaning the companies themselves.
Exactly. The pre-IPO companies, the ones whose equity you'd need to tokenize, they were mostly hesitant, reluctant to dedicate a chunk of their cap table to buyers of tokenized assets.
Their cap table, that's the breakdown of who owns what, right?
Precisely. Who owns what percentage, what kind of shares, how much they paid. Companies guard those very carefully.
So why were they hesitant about tokenized holders?
Well, they seem to see it as a big risk. Maybe regulatory uncertainty. The complexity of managing potentially thousands of tiny token holders.
Could it affect future funding rounds from traditional VCs?
That's a huge concern too, yeah. So this reluctance from the companies, the supply side, acts as a major barrier. It doesn't matter how much theoretical investor interest there might be.
It's like having diners ready to eat, but the chef won't cook the food.
That's a perfect analogy. The supply just wasn't there or wasn't willing.
And it isn't just Ott feeling this way, right? Chris Yin from Plume Network.
Right. Chris Yin, CEO of Plume, and they've got, what, $150 million in various RWAs on chain already, solar farms, Medicaid claims, diverse stuff.
So he's deep in the broader RWA space, and he echoes this skepticism about private equity demand specifically.
He does, and even more bluntly, he said, and this is the direct quote, if you look at the numbers, you look in the stats, you look what's going on, it's very clear the demand is not there.
Wow, that's a strong statement.
It is. Coming from someone running a platform with significant RWA traction, it suggests that the actual realized demand from retail investors for general tokenized private equity, outside maybe those huge famous names, might be way less than the hype suggests.
It really makes you ask, is this a solution still looking for its problem? Or maybe the market just isn't mature enough yet?
Could be either, or both. And digging a bit deeper into Ade's point about demand, he brings up brand recognition, which is crucial, practically speaking.
Meaning people only want tokens for companies they've already heard of, like OpenAI or SpaceX?
Largely, yes. That's what he observed. Unless a company is already a household name, already grabbing headlines, already part of the public conversation.
The demand for tokenized versions of that specific company is limited.
Right. He found demand tends to lean more towards general sector plays or maybe broader asset classes rather than diving deep into individual, lesser-known private companies.
Which makes sense if you think about it. How would a regular investor even research a private company they've never heard of?
Exactly. That's the challenge. Attracting tokenized investment for a lesser-known private company, even if it's doing amazing things, is tough. You're asking everyday investors to do serious private company due diligence.
Financials, management, market opportunity, stuff VCs spend weeks on.
Precisely. And most retail investors aren't equipped or, frankly, willing to do that for companies that aren't already famous. Traditional PE relies on specialized analysts for a reason.
So the concept sounds great, but the practicality of getting widespread, informed demand for every private company out there, that's a huge hurdle.
A massive hurdle. It seems like without that strong, recognizable brand, the demand just doesn't translate broadly.
Which raises that question. If only the big names attract interest, are we really democratizing access or just creating a new way to invest in the giants, a sort of winner-take-all dynamic?
That's a really critical question. What does it mean for all those innovative, smaller private companies that could maybe benefit from this? It's not clear.
Okay, so we've heard the skeptical side, grounded in practical experience, very compelling points. But
there's always another side to the story, especially with emerging tech.
right, there's a contrasting view. One that sees huge potential, real latent demand just waiting to be unlocked.
People who believe the appetite is there.
Exactly. And Paul Atkins, a former SEC chairman, actually offered a much different assessment on this.
Oh, interesting. A regulatory perspective.
Yeah, and his view directly challenges that notion that demand isn't there. He seems to think it's more about opportunity and innovation.
Atkins' viewpoint is definitely more optimistic. He stated it pretty clearly. There's a lot of demand on the investor side to be able to invest in private products.
So he sees the demand, just maybe not the right products yet.
That seems to be the implication. He views tokenization itself not as some gimmick, but as a genuine innovation.
An innovation that will help bring more diverse investment products to market.
Exactly. While he didn't specifically comment on, say, the Robinhood situation, his overall feeling seems to be that the underlying tech tokenization is a positive force. It can unlock opportunities.
Opportunities for investors looking for that private market access that's been historically off limits.
Right. He seems to see an inherent, maybe currently unfulfilled, appetite for these kinds of investments, and tokenization is the key to eventually serving that demand. It's a long-term transformative view.
And someone else echoing that confidence is Mirza Udin. He's head of business at Injective.
Yeah, Injective. They're building protocols in the RWA space, right? Facilitating these new asset types.
Exactly. And he's pretty confident about demand prospects for tokenized private equity. He sees it as a gateway.
Udin's reasoning gives us a good insight into why there might be strong underlying demand, even if it's not fully obvious yet. He argues that by turning equity into digital tokens, it gives everyday investors a chance to participate in markets once limited to venture capital and private equity.
So it's about access.
It's fundamentally about access.
Yeah.
And he clarifies, importantly, that this isn't about creating entirely new financial instrument out of thin air. He emphasizes this is not about creating new markets, but about making existing ones more accessible and liquid.
That's a key distinction. The demand for private market exposure is already there, he thinks.
That's his perspective, that retail investors do want to tap into those private company growth stories where a lot of value often gets created before an IPO.
And tokenization is just the mechanism.
It's the mechanism to unlock that latent demand by breaking down barriers like high minimum investments and, at least theoretically, improving liquidity by making stakes tradable. He sees it as evolving access to meet an unmet need.
We also heard from Kevin Rusher, founder of RAAC, another RWA startup.
Right, RAAC. They're working on access to things like tokenized gold and subsidized housing, broadening the scope.
And he definitely sees growth potential here, too. He highlighted that tokenization in private markets broadly has surged significantly this year.
So there's actual data showing movement.
Yeah. And importantly, he notes that private credit is already the largest RWA category on rwa.xyz, that tracking platform.
Okay, so private credit tokenization is taking off.
Which might signal, a broader acceptance and understanding of tokenization generally, maybe paving the way for private equity down the line.
That's plausible. Growth in related areas could build infrastructure and confidence.
So what's fascinating here is how these opposing views can kind of coexist, right? It paints a more nuanced picture than just yes demand or no demand.
Absolutely. Is it just a timing thing? Potential demand versus current realized demand?
Or maybe different market segments. Are everyday investors ready, as Atkins and Udden suggest? Is that desire for high-growth private companies real?
Could be, but maybe the infrastructure, the specific products, or even the regulatory clarity just isn't mature or trustworthy enough yet to really capture that demand scalably.
Ate's point about companies being hesitant, the supply side, that's still a huge factor.
And the need for brand recognition to attract retail investors who aren't doing deep due diligence. That suggests that while the appetite might be there,
the mechanism for safely and broadly satisfying it, especially for equity in lesser-known companies, is still very much under construction.
Exactly. It could be latent demand, just waiting for the right, legitimate, accessible products to emerge beyond the initial hype. It feels a bit like a classic chicken and egg situation.
Do you build the infrastructure hoping demand shows up, or does demand need to be overwhelming first?
That's the billion-dollar question for builders in this space.
Okay, so we've wrestled with the demand question, that fascinating push and pull. Let's shift focus now, because regardless of whether the retail floodgates are fully open, companies are actively building. They're developing different models.
Trying to figure out how to make this work.
So what do these different approaches look like? How are they trying to bridge that gap between potential and reality? Let's unpack Dinari's model first.
Okay, Gabeot's company.
Yeah, because their approach is pretty distinct, especially compared to that Robinhood example we talked about. They use a tokenization on demand model. Can you walk us through what that actually means?
Sure. Dinari's model is quite specific. And crucially, it's designed to directly address that underlying asset ownership issue, establishing a clear link.
The link that was missing with the Robinhood OpenAI tokens.
Precisely. Adi explained it like this. When one of our partners' customers wants to purchase shares, we go out to the traditional market, place that buy order, and tokenize the shares that were purchased specifically for that customer.
Ah, okay. So they actually buy the real shares.
Yes. That's the profound difference. Unlike the Robinhood tokens, which were synthetic derivatives just tracking value, Dinari physically goes out and acquires the underlying shares in the traditional market for their customer.
And then those shares are held somewhere.
Right. They're legally held by Dinari or a custodian, and that ownership is what gets represented by the digital token on the blockchain.
So the token represents a direct claim on a specific real share they bought.
Exactly. It's essentially digitizing a beneficial ownership interest. It allows for easier transfer and fractionalization on-chain, while the traditional shares stay put within the existing legal system.
That sounds much more robust, but probably more complex legally and logistically.
Oh, absolutely. Linking those two worlds, traditional finance and blockchain, seamlessly, especially across different countries, is a major challenge.
But it seems like that more rigorous approach paid off in one sense. They got U.S. approval.
They did. That's a truly significant milestone. Dinari became the first company to secure U.S. approval to offer clients tokenized equities using this model.
But interestingly, what are they focusing on selling right now?
Well, so far, their primary focus seems to be on selling tokens that track the price of popular publicly traded stocks. Think Tesla, Apple, NVIDIA.
To non-U.S. traders mostly.
Primarily, yes. So while they have the green light for tokenized equities, their current market activity is centered on well-known, highly liquid public companies.
Not so much the complex, illiquid private equity space yet. That choice seems quite telling, doesn't it?
It speaks volumes, I think, about the current state of play. Their success with U.S. approval is huge, but their focus on public stocks implicitly points to just how much harder and riskier it is to truly tokenize private, illiquid shares right now.
It's just simpler with public stocks. Established liquidity, clear prices, existing regulations.
Exactly. Compared to private equity, where valuations are murky, liquidity is near zero, and the legal structures for fractional ownership are much less defined.
So connecting this back, while Dinari is making real progress tokenizing public stocks with actual underlying shares,
it kind of highlights the nuances of the tokenized private equity debate. Their careful, regulated path is definitely a way forward, but it's one that leverages existing market structures.
rather than trying to completely reinvent the wheel for genuinely illiquid private assets.
Right. It's about minimizing friction with the current financial system, which seems like a pragmatic approach for now.
Okay, so Dinari's treading carefully, mainly with public assets, but to really get the wider picture, we need to broaden our lens beyond just private equity again.
Because the RWA tokenization space is much bigger than just company shares.
Definitely. Look at what Plume Network is doing. They launched their mainnet with $150 million in RWAs already on-chain. That's not trivial.
No, it shows real assets moving onto the blockchain. And the diversity is incredible.
What kind of assets are they tokenizing?
It really illustrates the versatility. Plume isn't just doing shares. They're tokenizing things like solar farms, tangible infrastructure assets, generating cash flows, Medicaid claims, financial receivables, basically, mineral rights, representing future value from land, even consumer credit, so lending arrangements.
Wow, that's a wide range. And RAC, Kevin Rusher's startup.
They're also working on diverse assets, providing private investors access to things like physical goals, a commodity, and subsidized housing, which is real estate with a social angle.
So if we connect this to the bigger picture, what does this diversity tell us?
It shows that while tokenized private equity is grabbing headlines and is particularly complex, the overall RWA movement is much, much broader.
It's tackling illiquidity across all sorts of things.
Exactly. Real estate, commodities, financial instruments. It's a wide trend of bringing diverse real-world value onto the blockchain for potentially better access and liquidity.
And maybe this broader innovation, the tech, the regulations being figured out for these other assets, maybe that lays the groundwork.
It very well could. Success in tokenizing, say, real estate or private credit, might build the rails and the comfort level needed for more complex private equity tokenization later on.
Makes sense. Okay, now let's pivot to the darker side, maybe. The inherent risks, the unanswered questions that still loom large over tokenizing private equity specifically.
Right, we can't just look at the promise. We need that critical lens.
And Ben Miller, the co-founder and CEO of Fundrise, offers a really strong dissenting voice here. He challenges the whole concept at a pretty fundamental level.
Miller's critique is sharp. It gets right to a core philosophical tension.
What's his main point?
He said, it makes no sense to me, honestly, because what you're doing is taking something that is inherently a long-term investment and making it something you can trade 24/7.
So forcing liquidity onto something that's meant to be illiquid.
Exactly. He's raising a profound question. Does imposing that 247 tradability fundamentally undermine the very nature of a long-term investment like private equity?
Because private equity usually requires patient capital, right?
Yeah.
You invest for years.
Often 5, 7, even 10 years. You're waiting for a big exit event down the road, an IPO, an acquisition. If you introduce constant trading via tokens, does that just encourage short-term speculation instead?
Flipping tokens instead of long-term commitment to growth.
That's the concern. Miller contrasts this with Fundrise's own model. They give investors access to private companies too, but through a venture fund.
And that fund acts like a traditional VC on the company's cap table.
Right. It maintains that long-term structure without the pressure of constant trading. It's a powerful argument about potentially misaligning the asset's nature with the tokenized structure.
Suggesting some things are just supposed to be illiquid for a reason.
Exactly. Are we building something better or just something different that attracts a different, maybe less suitable type of behavior?
That's a really important philosophical point. Now, building on risks, Mirza Udin from Injective, who is optimistic about demand, He also raised a crucial point for investors like you.
What was that?
He noted that tokenized shares often do not carry traditional rights like voting power.
Ah, yes. This is huge. Not a minor detail at all.
No. It fundamentally changes what ownership means, doesn't it? And investors really need to grasp this difference.
Absolutely. It's central to how we normally think about owning stock. If you buy shares in a public company, you usually get voting rights.
You get a say in corporate governance, electing the board, big decisions.
Right. Mergers, executive pay, you have some influence. But if these tokenized shares don't carry those rights, which is often the case, especially with derivatives or structures where someone else holds the actual share.
Then what does your ownership really mean?
That's the key question. You might have an economic interest, you profit if the value goes up, maybe get dividends, but you lack control. You lack influence. You can't hold management accountable in the same way.
It connects directly to what Kevin Rusher from RAAC said about risk.
Exactly. Rusher said growth will come with a lot of risk which need to be addressed, and transparency is key.
And transparency seems especially vital here.
Hugely vital.
Yeah.
Especially with these derivative-like tokens or complex structures where the token is just a representation, you need absolute clarity.
Clarity on what rights you do get. Who holds the underlying asset? What's the legal framework? How are decisions made?
Without that transparency, investors are taking on significant risk, often without the traditional safeguards of equity ownership. Understanding these nuances is critical.
It's less like being a shareholder, more like being a beneficiary.
That's a good way to put it. A distinct legal and practical difference.
And finally, let's circle back to that supply-side barrier Gabe Otte raised earlier, the challenge posed by the private companies themselves.
Their hesitancy to participate.
Right. He noted pre-IPO companies are often hesitant to take the risk of dedicating a chunk of their cap table to buyers of tokenized assets. This isn't just about investor demand or product design.
No, it's fundamentally about the company's willingness. And this corporate hesitancy is a massive bottleneck for scalability.
Why are they so hesitant, do you think?
Several big reasons. First, regulatory uncertainty is huge. The rules for tokenized private securities are still murky. Companies fear creating a complex mess of token owners without clear guidelines.
Easier to stick with what they know, legally?
Much easier. Second, the potential impact on future funding. Traditional VCs or institutional investors often prefer a clean, simple cap table.
Thousands of tiny token holders might complicate things, make acquisitions harder.
It could, yeah. It introduces uncertainty that big investors might just shy away from. And third, just the sheer logistical headache.
Managing potentially thousands of small token holders alongside traditional equity.
For a private company with maybe a lean finance team, it can seem daunting. The admin burden could be significant.
So this supply-side reluctance directly hits the viability and scalability of real tokenized private equity.
Absolutely. Regardless of how much retail investors might want in, if the companies won't tokenize their equity meaningfully beyond derivatives, the market will struggle to truly take off.
It's a powerful break on what could otherwise be rapid growth.
A very powerful break.
So wrapping this all up, what does it all mean? We've covered a ton of ground. It's clearly not simple.
No easy answers here.
On one side, you've got this undeniable promise. Unprecedented access for you, the everyday investor, to markets that were locked up tight.
That allure of fractional ownership, more liquidity for private assets, it's powerful, taps into a real desire.
But then on the other side, we've hit these hard, practical realities. Genuine questions about broad retail demand beyond the superstar names.
The real hesitancy from private companies themselves to open up their cap tables.
And that critical need for regulatory clarity, solid legal frameworks, and just complete transparency about what's being bought and sold.
But despite all these debates, especially around private equity, that overall RWA market keeps growing, right? Closing in on $25 billion.
Yeah, with private credit leading the charge, that underlying strength must mean something significant is happening in the broader space.
It definitely suggests a powerful trend, even if the specific path for tokenizing private equity is still being, well, paved very carefully, layer by layer.
Yeah, it feels like early days still for that specific piece.
Indeed. It's clear the innovation is real, the potential for a more accessible financial future is tantalizing. But the path forward, especially for tokenized private equity, is complex. It's nuanced.
So for you, the investor, what's the key takeaway?
Scrutinize everything. Understand the fundamental nature of the underlying asset, and crucially, understand the specific rights, or maybe the lack of rights, tied to the token you're considering.
That difference between a derivative tracking value and actual equity with real ownership rights.
It's paramount for your financial safety, for your understanding. This isn't just about cool new tech. It's about rethinking ownership, liquidity, long-term investing in this digital world.
The market's evolving so fast, staying informed is probably the best defense.
Absolutely.
So as this real-world asset market keeps growing, closing in on that $25 billion mark, what does the future truly hold for investors trying to get into private companies?
Will it just be the big brands? Will brand recognition keep dictating which tokenized assets really thrive, leaving us with a concentrated market for just those household names?
Or will the innovation eventually unlock new, unexpected corners? Will the everyday investor find ways to access a truly diverse range of private opportunities, maybe through new platforms or structures we haven't even seen yet?
Only time and continued market evolution will really tell, won't it?
It certainly will. We hope this deep dive gave you a clearer, maybe more nuanced picture of this fascinating, complex, and incredibly fast-moving landscape. Thanks for joining us.